The sharp sell-off that markets have experienced since the middle of March have led some to sitting out or at least delaying the decision to invest. But product providers like ABSA Capital have designed products that can take risk off the table and protect capital at different times. Should investors be using them? Ryan Saido from ABSA Capital is here to make his case. Well, sir, tell me how you can protect us from the volatility and the risk inherent in the market right now.
And I'd like to just point out, I think we had you on a couple of months ago and the markets were going upwards.
Yeah.
And now the markets are heading down, so the tone of the dialogue has changed somewhat.
Exactly, and it's volatility. That's the one thing that we can always be sure of.
I did warn you, and it's coming true. So it's always good to be on when you predict in the right direction. Just to stress quickly on structured products in general, because I think a lot of people are not really au fait with that term.
Can we talk about what they are?
Yeah, pretty much all we're doing is combining protection assets, bonds, with growth assets, options in one sort of transparent package for generally retail investors. Now it's a huge market in Europe, not so big here, but it is starting to grow. So in essence, what we're saying is, don't sit in cash because you're just going backwards. But here's a way to get into equity markets, commodity markets, whatever it may be, but without being fully capital at risk from day one. Now, the challenge is when you've got those two components within a package is you've got the interest rates falling, which obviously means you need to put more and more of your cash aside into the bond element to deliver the protection. So, a couple of years ago, you could put 60 cents in every R1 away to get 100 back in 4 or 5 years' time. Now that 60 is like 70, 75, which means you've got much less to spend in the option side of things. Now, the big problem with options is the more volatile the market that you're trying to access and writing options on those markets, the more expensive that option is going to become. And that's why issuers and index providers have, and you've seen a big trend, started to create these volatility or risk-controlled indices. Now, S&P, for example, last year did over $10 billion just in their volatility-controlled indices. And ABSA and the JSE have got their own top 40 vol-controlled strategy. In essence, by dampening the volatility, you make the options cheaper, you allow people more participation in
Is that lay enough?
No.
Warren?
I think so.
I'm sorry, you lost me.
No, that's fine.
Okay, so can we be a little bit more lay?
So think of volatility as risk. It's just a fancy word for risk.
That's when prices are moving in all directions.
Yeah. So the more volatile the market, the more it goes up and down in a day.
We've got that. We've got the volatility side of things.
Okay.
But I still want to understand the structured products. I'm not quite with you there.
Okay.
Okay, so we've got a volatile market.
Yeah. So let's say...
What do you offer me?
I'm saying to you, here is a 5-year fixed term investment where you put your money in today, it comes out in 5 years' time, I protect it.
And you grow it. Do you grow it or do you just protect it?
No, well, if we're wrong and markets really fall out of bed,
you still get your capital back.
You get your capital back.
Okay.
Right, so
if you
really
were invested in the alternative, that would be, let's say, an equity fund.
You're going to go through the downside.
You'd suffer with the downside. You'd hope that the fund manager would be, making stock picks and market timing to not lose one for one with the market. But invariably, they all trend downwards.
Would you then take on the risk of the downside? You absorb that as an institution.
It's priced into the optionality side of things.
So it's going to be very expensive for me.
Not necessarily. Not necessarily. They're no more or less expensive than your actively managed funds, right? The key is that they're very transparent. For every your R1, 75 cents goes into the protection element, which becomes 100 cents in 4 or 5 years' time. We spend 5 cents on admin and broker fees or whatever that may be, and the rest is invested in the optionality. And if I said to you, I'd sell you just the naked call option with protection on the top 40 today, I could give you maybe over a 5-year term 65 to 70% participation in the top 40.
Okay, so I think.
But if I did a vol-controlled or a risk-optimized version of that, I could give you 100% participation.
Quick question from the gallery: what is the difference between that product and a smoothed fund?
the very nature of the fact that the one is open-ended in its nature, and the one is a fixed-term investment, straight away differentiates the two. In a smoothed fund, you'll have techniques that are sort of looking to smooth that performance into perpetuity.
But yours is a fixed
Whereas
term.
ours is just a strategy that actually smooths. It smooths the performance. It's not a smoothed fund, if that makes any sense.
We've had a lot of debate around this great rotation, and the perception as South Africans is that you should have a great exposure to equity, but that's certainly not the attitudes of investors offshore. How have structured products been taken up since the global financial crisis?
There's definitely been a downturn in the sort of total AUMs raised every year by issuers, but I think that's a function of regulations. A lot of the European regulatory bodies, UK and the US bodies, have sort of almost bogged the system down with new regulations, and issuers are just trying to work their way through that before they get back into the market. But the other big challenge there is, as you know, rates are almost zero. So a capital protected product is extremely difficult to get out over there, because that protection is costing you maybe 95 pence in every pound. There you'll find a lot more products where there's capital at risk. So there's a barrier. They employ barrier options where you have to wait for the market to maybe fall 40, 50, 60% before your capital's at risk. So again, it differentiates itself from a long-only fund where you maybe suffer from day one. There's this barrier where the markets could be falling, but you don't suffer a capital loss unless it really falls out of bed and doesn't recover.
So what's the catch? Because now I'm thinking, all right, well, there we go. I give you my money and we say fixed term. Let's just say 500 Rand.
Mm-hmm.
End of 5 years. There's no downside for me. I am, irrespective of what happens, I'm getting that 500 Rand back. Is that right?
There's two
catches.
No, they're not catches, but there's two things people should be aware of when they go into it. And it's a key differentiator between the sort of collective investment scheme world, where you're what they call bankruptcy remote. So ABSA may issue a fund, but it's bankruptcy remote. So no matter what happens to ABSA as the institution, if it no longer exists in 5 years' time, your funds are still protected. With a listed note, which is what the wealth optimizer is, you're exposed to issuer credit risk.
So if ABSA goes bang, I
you have
lose
to stand
my money.
in line with everybody else to receive X.
All right, but it's a fair risk. I mean,
but that's the same as if you had your money in a
what's the other one?
in
You
a
said
deposit.
there are two catches.
The other one is not really a risk, but it's a concern a lot of people bring up, is the perceived illiquidity of a note versus an open-ended fund. They're saying, well, this is a 5-year note. What happens if I get divorced and I have to pay out my wife after 2.5 years?
Which is fair, considering 2 out of every 3 marriages don't work.
Okay. So luckily I'm still married. Idea. There you've got, there is daily liquidity, but remember what I said, we've got 75% in a bond and 15 cents in an option. What you find is that 75 needs to grow to 100. If you're coming out after 2.5 years, you haven't given it its full time to work itself back to 100. That's where we say, generally, if you withdraw early, you're probably going to suffer a capital loss, and that puts a lot of people off.
Okay.